And welcome back. It's Jason Walter here, and here's your latest housing market update. And thank you so much for joining me in today's video. I have a lot to share. So let's first talk about a new report that was just announced from the MBA that was published on March 8th, which of course is today. Hope you guys appreciate these timely housing market updates. So in this report, this actually caught me by surprise because mortgage applications increased by 7.4% compared to 1 week ago. That of course includes refis plus purchases. So the refi index actually increased by 9% compared to the previous week, but still down by 76% from 1 year ago. Meanwhile, the seasonally adjusted purchase index, which of course is a measure of the amount of people who are submitting loan applications to buy houses, actually increased as well. It increased by 7% compared to 1 week earlier. But having said that, we're still down by about 42% from 1 year ago. There's a few things I want to mention regarding this increase of applications for refis plus purchases. So for purchases, this is actually the first increase in the last 4 weeks. So the previous 3 weeks, we had decreases in applications for home loans, and this is actually the first increase in the last 4 weeks. On top of that, for the previous 2 weeks, we had more or less 28-year lows for applications for home loans, the lowest levels going back to 1995 for the previous 2 weeks. In any case, what I'm getting at is that because we had very, very low levels back in the previous 2 weeks, again, 28-year lows, it's not a huge surprise to see this slight increase compared to 1 week ago. But again, compared to 1 year ago, down by 42%. And also, Joel Kahn, who's the MBA's vice president and deputy chief economist, said that mortgage rates continued to increase last week. The 30-year fixed rate rose to 6.79%, the highest levels going back to November of 2022. I believe he's talking about average rates according to Freddie Mac's weekly survey. So actually, let me just share this with you guys right now. So here's the 10-year treasury. I should say the yield on that is more or less flat today. It was actually flat yesterday as well on the 7th. The yield on that is just under 4% right now. But obviously much higher compared to 1 year ago. 1 year ago, the yield was more or less 2%. So the yield has more or less doubled compared to 12 months ago. Also, according to Investopedia.com, as of today, the average 30-year fix with people with great credit is at 7.09%. Also, according to the Mortgage News Daily, let me just refresh this, the average rate right now is at 7.01%. For a 15-year, it's at 6.5% approximately, 6.5% for jumbo, and around 6.5% as well for FHA as well as VA. Also, have a look at this because average rates right now at approximately 7.01%. This is about 279 basis points higher compared to 12 months ago. Approximately a 3 percentage point increase compared to 12 months ago because 1 year ago, rates were averaging at 4.22%. What's also interesting to note here for March, rates haven't really moved much at all. They went from about 6.94%, the increase to 7.1% on the 2nd, and have been hovering around 7% ever since then. But again, because rates were more or less around 4% 12 months ago, this is decreasing home buying demand compared to last year's levels we saw. And also for someone looking to buy a $450,000 home today, putting 5% down, if you compare their housing payment today versus at the beginning of February, they're going to pay approximately $300 more per month to buy that same house today versus just 30 days ago. And I have some more news to share regarding a lack of housing affordability later in today's video. But let's first go back to the MBA's report here because they say here, even with higher rates, there was an uptick in applications last week, both for refis plus purchases, but that was in comparison to 2 weeks of declines at very low levels. Again, the previous 2 weeks, the lowest levels going back to 1995. Joel Kahn also says many borrowers are waiting on the sidelines for rates to come back down. Leave me a comment below, by the way, if you guys are waiting for home prices and rates to come back down before you buy a house. The MBA also reported that the share of applications for home loans for refis was at approximately 28.9%. So this means approximately 3 of every 10 applications for home loans are for people who are looking to do a refi, which actually I'm really surprised by that, given the fact that rates right now are at the highest levels since approximately November last year. Now, here's something nice to see though, because the adjustable rate mortgage share, or the ARM share of activity, increased only to 8.6% of total applications. So out of all the applications for home loans plus refis, only 8.6% were for ARMs. They also reported here that the FHA share of total applications increased to 12.8%. VA made up about 12% as well. USDA only made up about 0.5% of total applications last week. Going back to this issue we have in the US right now, a lack of housing affordability, there's actually two new reports I want to share with you guys, actually from Redfin. And Redfin reported there was half as many affordable houses in the US that was for sale in 2022 compared to 2021. So for example, 1 in 5 home listings, in other words, a home listed for sale, was deemed affordable for the typical US household, down from 2 in 5 in 2021. So this means that approximately 21% of US houses for sale in 2022 were affordable for the typical household in the US. And that's down from about 40% that we saw in 2021. And on top of that, this 21% share is the lowest share on record for as far back as 2013, as far back as Redfin data goes. So 2022, only 21% of houses were deemed affordable. Last year, or I should say in 2021, it was 40%. And going back to 2013, there was only one other year, which was 2018, in which the share there dipped below 40%. And in fact, over the past 10 years, the most affordable year for housing was actually in 2013, where 50% of US households couldn't afford to buy a median price home then. And by the way, this is according to analysis by Redfin of home listings in 100 of the most populous US metro areas. A listing is considered affordable if the estimated monthly mortgage payment is no more than 30% of the local county's median income. And based on this analysis from Redfin, the number of affordable listings fell 53% from 1 year ago in 2022, and that's the largest annual drop in Redfin's records. And of course, one of the main reasons why we have this lack of housing affordability in the US is because, of course, prices in the US have skyrocketed over the past couple of years. And of course, rates or mortgage rates have also skyrocketed as well. The average 30-year fix across the United States in 2020 and 2021 was 3%. Now rates are close to 7%. And because the all-time record low for average rates was set in January of 2021 at approximately 2.65%, which by the way, in August of 2021, rates were about 2.7%. Anyways, at 2.7%, when we compare that to rates today at around 7%, this means that rates have increased approximately 4.3 percentage points from the all-time record lows that was set in 2021. And because of this, this causes a 40% decrease in buyers' purchasing power. Redfin also notes here that the pandemic housing boom caused home prices to surge and they increase faster than income growth. Of course, this makes sense, right? We can't have home prices increase by 20% in one single year and have wage growth of about 5% or less, right? It's not sustainable. I've been talking about this on the channel for quite some time. Sad but true. So while home prices have fallen 12% from May's peak last year, they remain about 32% higher than they were before this pandemic started, roughly 3 years ago. On top of that, there aren't enough houses for sale, which is keeping prices more afloat than they would have if inventory was skyrocketing. So there's fewer new listings in January than any other month on record aside from April 2020, which is obviously the onset of this pandemic, which brought this housing market to a halt back in April and March of 2020. Now, here's something I want to clear up right away because they say here there's not enough houses for sale. I would say, historically speaking, there's not enough housing inventory. So here's a look at housing inventory according to altusresearch.com. So for the week ended March 3rd, there's approximately or just under 420,000 houses for sale. 1 year ago, there was approximately 240,000. 2 years ago, back in 2021, there's approximately 318,000 houses for sale. So when we compare the current levels right now at about 419,000, this is higher than the previous 2 years. But looking back to pre-COVID levels, again, right now at about 419,000, back in February, or let's call it March 2020, right before the onset of COVID, we had approximately 720,000 houses for sale. Back in 2019, there was about 817,000. And back in 2018, there was approximately 790,000 houses for sale. Therefore, even though housing supply is far greater than the past couple of years, we're still well below pre-COVID levels. One caveat I do want to mention though is that we do not need to see inventory levels at pre-pandemic levels in order to see a housing market correction like we're currently seeing right now, because home prices nationwide have come down about 12% compared to the highs we saw back in May and June last year. On top of that, according to my analysis of the California Association of Realtors data, which I posted about, a week or so ago, in the San Francisco Bay Area, home sold prices are down by about 35% compared to the highs seen last year. So in other words, even though we have far more houses for sale right now compared to the past couple of years, it's still below historical levels. But despite that, our housing market's still slowing down greatly. And according to Redfin's deputy chief economist, Taylor Marr, he had this to say: "The good news is that housing affordability should improve. Mortgage rates will eventually come down as the Fed makes progress fighting inflation, and home prices have already begun falling." I have to agree with him regarding this, because as the Fed continues to raise rates, which by the way, the street is forecasting the Fed is going to increase the federal funds rate by 50 basis points in a couple of weeks. And as the Fed continues to raise rates, or the federal funds rate, that's likely to put downward pressure on inflation, which would likely to cause mortgage rates to decrease once inflation gets under control. Of course, I am not a real estate market fortune teller, so time will tell, and I'll definitely keep you posted. Redfin also noted that the Biden administration recently announced that it's cutting mortgage insurance rates for homebuyers who take out loans backed by the FHA. This move is estimated to save roughly 850,000 home buyers an average of $800 per year. It goes into effect on March 20th, by the way. Redfin also noted that the 100 most populous US metros all had fewer affordable houses in 2022 compared to 2021. So every single of the 100 most populous metros had a decrease of more affordable housing in 2022. In Boise, Idaho, for example, the number of houses for sale that were deemed affordable to the typical local household plunged 86% year over year. That was followed by San Diego, Salt Lake City, Oxnard, California, which is very close to Ventura, and Austin, Texas, running out the top 5. They also provided a map here showing the cities in which they are most affordable in the US, and also the cities which are the least affordable. So San Francisco, California actually had the lowest affordability share. Look at this, San Francisco. The share of affordable housing there was at 0.3%. The share of affordable housing overall in San Francisco, only 0.3%, which is absolutely insane. Go figure why home prices are down greatly compared to the past couple of years. In contrast, Akron, Ohio had the highest share of affordable housing at 56.7%. Other areas that caught my attention here was Austin, Texas, a share of only 4.4%. That's a share of US home listings that were deemed affordable to the typical household in that area. 4.4% in Austin, Texas. Let's look at Salt Lake City. Salt Lake City is at 4.8%. Sacramento is at 4.4%. Portland, Oregon at 3.6%. Seattle, Washington at, at 5.4%. Also in Las Vegas, the share was only 7.3%. Denver, Colorado, which is actually right there, 5.6%. And also we have Phoenix, Arizona at 8%. And Tucson, Arizona, which I think is right here, Tucson, Arizona at 9.3%. Los Angeles was at 0.5%. Oxnard was at 1.2%. Riverside at 4.3%. and San Diego, California at 0.9%, which, by the way, of course, there's a lot more cities in this map here. So actually, we'll share the link below if you guys want to check that out. But anyways, thank you so much for checking out today's video. I appreciate you, and we'll see you on the next video.